Welcome to Manage Your Damn Money with Ben and Malcolm, where we trade in personal finance advice for entertaining conversations about money, millennials, and the young at heart. Welcome, world, to yet another episode of my favorite show about money and personal finances, Manage Your Damn Money with Ben and Malcolm. Mr. Malcolm Ethridge, licensed financial advisor. How are you doing today, sir?
I'm good, man. I'm good. I'm a little bit lost without football. I got to be honest.
What do you mean? Whatever do you mean?
I don't really know what the weekend is for.
Well, actually, there's a fix for that, but continue.
The XFL?
Yes.
I'm not there yet.
Okay, did you watch any of it?
Not really. I was in a bar, so I watched it without the sound, so you don't really get the full effect. DC has a team, which great. Mm-hmm. You know, I'll get to go to Audi Field and like watch a live game if they're any good. Yeah. But it's not the same. Okay. It's not the same.
Based on the little bit that I watched and the scores and the broadcast, the television broadcast, it felt like a really professional, put together product to me. Like this can be an entertaining thing to run on the background, you know, as you're like cleaning your house or something. You turn and look and see like a great play.
How disappointing is that though, if you're a player on the field and you know that people are basically cleaning up their house to the soundtrack of you playing football?
Listen, opportunity is opportunity. It sounds like to me there's like another layer of opportunity somewhat.
Well, I have heard people saying though that the players in the XFL play extremely hard in comparison to when you watch like an NFL game and the score is already lopsided and whatever. Right. Because these are the guys that are trying to make it to the NFL. Right. Like they've either gotten cut from a team and so they aren't there now, or like didn't get drafted out of college or whatever. Right. So they're playing for something because they only make about $55,000 a year on average.
I read that. For how many games?
10.
10 games? I mean, that's not terrible for like 10 weeks of work. For 10 weeks of, I'm sorry, for 10 weeks.
The amount of risk that these guys take and
that part.
The amount of banged up your body is when it's all said and done, I'm going to need considerably more than $5,000 a game. Like, come on, man.
I'm trying to look at the bright side here. Well, anyway, on this episode of Manage Your Damn Money, the conversation at hand is the evolution of the self-taught investor. And we're going to be getting into that soon. But before we do, as we do on every show, it is now time for headlines. I'll share my salary information if you share yours. This is a January 2020 piece on the New York Times by Jessica Bennett. It reads, "It was a few years ago into my career that I first talked to anyone about my salary, and then I could not shut up about it. I negotiated my first raise after I learned that a male colleague with the same title was making significantly more than I was. As a freelancer, I often shared day rates and consulting fees with friends in my field so we can know which companies to tap for more. Later, when I took a staff job, a coworker and I went out for drinks to get to know each other and ended up sharing our salaries before the appetizers hit the table. That helped me lobby for a better rate when it came time for my review," Malcolm. So Malcolm, I feel like this is a thing, and it might be just because it's something that I'm paying attention to. And I know we've talked about it.
I know you're a big proponent.
Yeah, I am. We talked about this in a previous episode of Manage Your Damn Money. Why is having open discussions with friends and colleagues about compensation at work, at least in my eyes, seeming to pick up steam in this era of professionalism?
I think it's becoming a more common conversation because companies are recognizing that there's going to have to be some level of fairness when it comes to closing the gender wage gap, the pay gap, whatever you choose to call it. And one of the ways you make meaningful strides to get there is to just be honest about who's getting paid what for what. Right. Because if I am a woman who graduated with a master's degree in whatever the subject matter is that we work in, and I am getting paid less than a guy who's got a few years less experience and has just a bachelor's degree in the same field.
That's a problem.
There's no reason why we should be making the same money, let alone
making less.
Lopsided him to me. Right. So I think, you know, the conversation around pay equity and closing the wage gap has lent itself to this being a quicker way to get resolution in that.
Right. And in my mind, I just think like information, you can't do better if you don't know better. I feel like that's something you would say.
Potentially, but I'm also not as much of a proponent of sharing salary history as you are.
Yeah.
I
don't know about with like coworkers, because that can create a bunch of issues. But I do think amongst friends and trusted like associates, I think that makes sense somewhat.
But what if I know one of your coworkers?
I mean, there's caveats here and there, but I just think
DC is a small city, so like it's realistic that I could know one of your coworkers, and then now I know how much you make because you told that coworker that, like, from the I agree that some level of transparency lends itself to that, but I think it's on the side of the employer to keep some level of normalcy among who does what job, and that gets them paid what.
I see.
So when you look at like Silicon Valley, for example, program manager or a front-end engineer versus a user experience engineer, right, are all three different levels of work,
right?
Three different levels of expertise, experience, everything else. There's guidelines basically for who gets paid what in those roles.
And what band.
And obviously you can outperform or underperform based on your own, how you got into this. But for the most part, it's going to average out pretty close to that middle.
Right.
To me, that's really the thing that matters more than determining that, because I have to publish it to everybody, we're just going to pay everybody the same thing because frankly, everybody's not worth the same money to their employer.
Mm-hmm. Well, the article continues. Everywhere I turn, it seems female friends, colleagues, and mentees are quizzing each other about money, how much they make, their stock options, and signing bonuses, how they negotiated, and what their dream number and their walkaway number is, or if they have one at all. A person quoted for the piece said, "I make all my friends, no matter their industry, talk about this. I just think we need to learn from each other to know what's reasonable, what's possible, and have information to make informed decisions." It went on to say, talking to a colleague can help pinpoint the going rate or range, particularly in newer industries or creative fields where there isn't a precedent for what you should be making. And of course, there's the whole wage gap thing, which Malcolm alluded to. And so it's interesting, though. One of the things that this, for me, begs the question of, with not employers, but employees having conversations amongst themselves, like let's say that becomes somewhat of the norm, how does then would that intrigue or push employers to maybe be a little bit more public about what they're doing in terms of salary ranges?
I don't know that it does.
Okay.
I don't know that as the employer, I feel like I am required to publish that information in any meaningful way.
Right.
Because as soon as you put it in writing, now you're bound to that too. So I could go hire the next Ben Carter who does the same job as you do with 5-10 years less experience. That person's now looking at that published rate saying, that's what I think I should get paid because Ben gets paid that and he does the same job, let alone all of the different circumstances that were happening at the time that happened. And so I just, I'm looking at solely from the perspective of the employer who would now have to pay all of these people according to what one individual has been able to negotiate for themselves.
Okay.
All of you aren't them. I mean, there are some people who are outliers and outperformers that you have to make sure that you protect.
Right.
You're not going to give Tom Brady money to, Teddy Bridgewater. Like, they both play the same position, but one of them is significantly better at it than the other one. I think about it the same way.
Okay, interesting. Well, I think, like I said, I think information is one thing you can't go wrong when you have on the employee side. Is there any other benefits you can think of if you were to put on your employee hat and say this would be beneficial? Assume the person is trusted. Assume that there are no connections or leaks for the information. What value can you think of that it lends itself to actually sharing some of that information amongst friends?
So I think, to your point, information is power among women who share their salary information with each other because it gives them the confidence to have some data to stand on to then be able to ask for more and negotiate more in that conversation in a way that I think doesn't exist without that. The issue that I see that creating, if it's just women sharing information into this pool, is that you're still talking about a 70 cents on the dollar wage base. And so now without the data from the guys who make more in most cases infused into there, you're not necessarily getting to equal pay. You're still getting to better pay.
Right.
So that would be the thing that I think maybe that's stage one, is just having open enough conversation about it that it helps you feel confident enough and comfortable having the money conversation when it comes to inside of your workplace.
Right.
But then at some point, you've got to incorporate guys into the conversation who will honestly give you that data and feedback so that you can really get to parity.
Right, absolutely. Well, that's a good point, Malcolm, actually splitting it up that way. Want to remind you, you can catch past episodes of Manage Your Damn Money on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a rating and a review on any of those platforms. That helps more people catch the show. We were recently rated as 39th in the investing
Moving on up
category on Apple Podcasts. So we're doing big things here at MYDM. If you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. And of course, you can always catch us on Twitter and Instagram. My handle is @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
You can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. Welcome back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is the evolution of the self-taught investor. Many things have been said about investing in the stock market. Malcolm, maybe you've heard of these. That ain't for me. I don't know nothing about that. It seems too complicated. And a good one, they be cheating people out of their money. Trust, Malcolm and I have heard it all.
Who are these people?
This might discourage money enthusiasts like ourselves, but because we are who we are, we will persist in making sense of what it means to invest. On this episode of Manage Your Damn Money, Malcolm and I are going to take an in-depth look at the evolution of an investor, particularly in investing in the stock market, Malcolm. So inspiration for the show is two things. I feel like we haven't talked about this at least through this lens in a while. And then number two, we're still inside of like a record market bull run, right? Can you share a little bit more about that?
Yeah, basically. So 2008, the market cratered, as everybody is very familiar with. I think 39% is what the S&P fell by the end of that year. And then basically March of 2009, the market made back all of what it lost in 2008. So first point of reference for the whole show that we're going to talk about, staying invested was the thing that really made the difference for a lot of people
during that time.
But having the stomach to be able to ride that ride is what really made the difference. But so essentially from March of 2009 to now, the market has gone like 380% or something, which is just unheard of. Normally a bull market cycle lasts anywhere from like 5 to 7 years, and we're knocking on 11. So it has gone like significantly farther than anyone thought it would, you know, starting this decade.
And hence the value of this conversation today. What have you heard from friends and associates about why they're not invested? And I actually step out and say, let's set 401ks at work and things aside. When we talk about stocks exclusively and just kind of investing that way, what do people say when they say I'm not invested in this is why?
Frankly, I know a lot of people who really would want to be, but having the discretionary income to take that risk is their biggest hurdle.
Okay.
So you do have quite a few people who, they're invested in Bitcoin, and you laugh, but I'm dead serious. I get people sending me messages on LinkedIn and whatever that are like, when is my Bitcoin going to bounce back?
Oh my God.
I didn't tell you to buy that junk in the first place. But yeah, so you have people that are invested in like that, people that call themselves Forex traders, foreign exchange traders, which to me is just one big scheme, but scam, but I'll put that aside for a second. You have quite a few people who call themselves actually trading because all these platforms have now made it free to trade, and so they call themselves trading on a regular basis, even though it's companies you should just be hanging on to for more than a week and not driving yourself crazy. So there are some people who are there who could be doing things differently and better, but a lot of people that I talk to personally, like in my own orbit, are wanting to be invested outside of their 401k, but they haven't gotten to the point where they're contributing enough to that alone that they can afford to take the risk of investing separate cash in the market.
What makes it? I think for me, at least over the course of my entire life, when I hear things, so I started investing like you early on at a younger age, I think there's just a general hesitance towards it because it feels like it's difficult to understand.
It is.
And that's really where it starts and stops for a lot of people. But that's why we're here. So we're going to put on our capes. 5 great ways to learn about investing in the stock market. This was an article that we picked up for this particular show. It was in October of 2019 on collegeinvestor.com by Alexa Mason. It says, learn from investing books. That's a big one. I feel like there are a number of books that you and I have both read that have contributed to our knowledge of investing in general.
And everybody's got an opinion.
What do you mean?
As far as the different types of books that are out there.
Oh, yeah.
Everybody's got an opinion.
Yeah, you just got to start somewhere, honestly, to whet your appetite.
So, like, there's the folks who are very staunch supporters of Bogle. I can't remember his first name, but the guy who founded Vanguard.
Okay.
They only buy indexes.
Right.
Index only, set it and forget it kind of folks.
Right.
And then you have the folks who follow Berkshire Hathaway guy, what's his name? Warren Buffett. And I'm only buying individual companies and I'm just going to buy them and hold them for the rest of my life.
Right.
Then you've got people who consider themselves day traders.
Right, correct.
So there's books out there for everybody.
Right.
And you just have to kind of figure out who you actually think knows what they're talking about and block out the rest.
And we'll talk about more about that soon. Also, learn from investing courses. We live in a world now where information is ubiquitous. It's everywhere. You just got to pop on the Google machine, as they say, type in something and get something to get you started on.
Same thing though, figure out a filter to determine who's reputable to learn from. I have had several offers that have come from people to teach investing courses, and I've passed on all of them. A lot of times it's because the people putting it on I didn't think were worth attaching my name to.
I see.
But then that means that the person that they went and got wasn't me.
Right.
So I have to assume that there's a little bit of a drop off.
A little bit of fall off.
What they're delivering.
Hilarious, dude. And then also you can learn from stock simulators. A stock market simulator is just as it sounds, a program that simulates the stock market. It's basically an investing game that lets you practice investing in the stock market. Now, Malcolm, these have been around for a long time. I think as early as when we were like teenagers. Talk to me about what your thoughts are on the value of a simulator versus like just kind of following it. Like what value would a simulator have for a person getting?
I think they're great for kids. So I'm actually just coming off of a board seat for the National Academy of Finance, which is an organization that basically pushes financial literacy down to the high school level and gets kids in their last 2 years of high school prepared to learn about like accounting, finance, all those kind of things to go into those careers. One of the things they get as part of their curriculum is a stock market game. It's a simulator and they compete with other schools in their local area and what have you.
Wow.
So they're all given the same $5,000 to start. And
Fake
it's up to them
$5,000.
a fake $5,000, and it's up to them to grow it, and whoever does the best wins.
What's the period of time?
They have the whole semester.
Wow, that's not
so
a
what
long
is that,
time.
like 2.5 months.
Yeah.
And so, I mean, you have some that'll bet the whole house on Tesla, and you have some that'll actually create like a diversified portfolio. And I mean, sometimes Tesla wins, and other times the diversified portfolio wins. But I say that to say for that level, it's awesome, right? When you're a 16, 17, 18-year-old getting exposure there, it's great. Beyond that, you get beyond college. I'm not really that excited about simulators because it's similar to like playing blackjack on your cell phone, right?
You don't get anything from it.
You're not going to win. You're not going to lose. You don't take away anything other than I just killed some time.
Right.
You really need to have a dog in the fight, as they say, in order to really feel like you're taking the risk associated with the decision that you're making. Because in the simulator, I'm going to bet it all on Tesla. And I keep using them because they're like the most volatile stock I can think of off the top of my head. But you get what I'm saying. Like in the simulator, I'm going to do things I wouldn't really do with my own money.
In real life.
And that's what really matters.
Right. Definitely. Then the last point was just generally learn from the internet, of course, with your proper Malcolm filter on for credible information. So a question that I have for you, Malcolm, is there a difference between what we're talking about in terms of investing in stocks and your 401k contributions? And talk to me about how those two things are different and also the same.
Yeah, so 401k plans are two things. One, meant to be super long term. So they are accounts that you and I are in our early 30s. So for example, it's realistic to think it could be 30 to 35 to maybe 40 years before we're realistically needing to touch money that's been saved into our 401k.
Certainly.
That is invested a completely different and separate way from how you would invest excess cash that you're now creating an investment portfolio with. Right. So everything in your 401k should have a long-term mindset around it, where you very well could just buy the S&P 500 index and ride that wave for a really long time if you chose to, or the target date fund inside of there where they manage it on your behalf. But the second point in that was going to be, don't manage your 401k as if it's a regular brokerage account that is meant to be shorter term investing.
You don't need to be changing your selections over and over.
You don't need to be trading in and out of, I bought, large cap growth and sold large cap value because I heard something on CNBC today that made me decide that was a good idea. Or they just sent out the report, the annual funds report that shows me that this particular fund got more stars than this particular fund did by Morningstar. So I'm going to shift over to that one. It's really not meant to be, an active trading situation. It's really meant to be a longer term approach.
What are the biggest psychological barriers that people have when it comes to learning about investing in the stock market as a self-directed investor? Like what is that thing that serves as the wall between them and getting started? Let's assume there's some discretionary income that they have available to actually do that.
What do I buy first?
Okay.
That's really the thing. Because everybody's focused on Amazon seems like a great thing, but what if it's not? Tesla seems like a good idea, but what if it's not? And instead of just getting started, it's all this paralysis by analysis. So rather than just, like I say, pick 5-ish companies that you really feel good about, you have a thesis for why they're going to be a good investment, and just get started. People tend to really outthink themselves over it.
I remember my first stock was Apple. It was $200, I guess, and some change when I bought it. And then I just looked at it on a regular basis for the next year and a half. I was in high school, I think. So anyway, and that's how I got started. So I imagine other people can too. But I want to remind you can catch past episodes of Manage Your Damn Money on Apple Podcast, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a rating on any of those platforms. That helps more people catch the show. Of course, if you have a question or a topic you want us to cover, send it to us, info@manageyourdamnmoney.com. And of course, you can catch us on Instagram and Twitter. My handle's @MYDM1. Malcolm, what's yours?
@MalcolmOnMoney.
And you can catch us on Facebook, facebook.com/manageyourdamnmoney. This is MYDM with Ben and Malcolm. We will be right back. back to Manage Your Damn Money with Ben and Malcolm, where today's conversation at hand is the evolution of the self-taught investor. And I think it's appropriate now for us as co-hosts of this show to share a little bit about the evolution of Ben and Malcolm as investors in the stock market.
Well, you just told us you bought Apple and you made $1 million.
I wish that was the story. So we know my first introduction to investing in the stock market specifically was Apple. Malcolm, what was yours?
Mine was actually Nike.
Okay.
So my first stock I got when I was 12, and the reason it was Nike is because I was a kid who grew up in the family who was like, we're not buying, I'll call it frivolous things. Yeah. So like Jordan sneakers that were $150-ish at the time.
We literally had the same upbringing when it comes to sneakers, specifically.
So it was, so you get where I'm going. It was
90 was like the cap.
Why am I? No, then we didn't have the same upbringing. Like 19 was the cap.
Whoa.
So I went to school wearing Payless shoes.
Oh my!
Where I grew up in D.C. with a bunch of kids riding the metro and stuff in their Jordans. Right. So they're like, so I had all the jokes.
Right.
So
ooh, that's a hard
when
life.
I learned what tell me about
it. My.
So when I learned what how stocks work and the fact that you actually own a stake in the company, it made sense to me that I would own shares in Nike, because that meant when my friends, my classmates' parents went and bought them that next pair of Jordans, they were secretly paying me a piece of every purchase that they made. And so the vindictive 12-year-old was like, this is the way that I'm going to get the last laugh.
You're sitting there whispering, snickering to yourself, I own your shoes.
Basically.
Boy.
Basically, like not even I own your shoes. Like 12-year-old Malcolm was like, I own you. You know, just so you know. Why don't you go and get another sweatsuit to match those shoes you just got? Why not?
That's funny.
So that was my first
entree. Mama
into
Ethridge had you set up on the metro here in Washington, D.C. Okay, for me though too, before the Apple stock, I'm thinking back now, you're talking about that triggers me to think about, like, I was going to, as a kid, around the age like between 10 and 12, to an investing club with, I believe if I remember correctly, Doug Jones, and it was like something his mom had put together. I don't even really remember how it came together, but it was like a...
Who is Doug Jones?
He's a kid I grew up with.
Oh, okay.
Yeah, anyway. And his mom, Veronica Jones, so I think it was something that was put together, and it was like a bunch of kids and adults in a room, and then we would look through the newspaper, and I vaguely recall looking at Nike stock in the actual paper, because obviously this was pre-internet blowing up like it has now. So that was one element. And then for me, like after that, I think at 15, I got a subscription for my birthday to Money Magazine. So that was the information component, right? And then at one point before the Apple stock, I invested I don't even recall it's not investing. Like I opened up a certificate of deposit for it was maybe either $500 or $1,000, one or the other. And I just looked at it almost on a daily basis for, I guess, a full year.
A CD?
A CD.
That was like watching paint dry.
Yeah, it absolutely was. I was like, ooh, this really isn't working.
Oh, man. Yeah, no, a CD is like it's the opposite of...
It's real bad. But as a kid, you ain't got nothing else better to do. Then it was the Apple stock. And then at 20, my mom was talking about going to open some retirement account. And I went with her. And I ended up opening a Roth IRA alongside her, just as well, I know I need to do this. And I think I did that at 20. So those were my introductory elements to the stock market.
So in middle school, when you mentioned my mom, you made me think about something. So my math teacher in middle school, I can't remember if it was 7th or 8th grade, Mr. Russell, used to take one class each week to teach us about the stock market instead of algebra. And because he was super into the markets.
Come here, boys and girls. Let me teach you something that you can really use in the world.
I mean, that might be what he was on to. He was like, this algebra thing, I'm not quite sure. They're paying me for this, so I'm going to teach you, but this is where the money is. That might have been his thing. I don't know. But anyway, so he basically, as part of the class, would have us choose a stock, and that was our stock for the whole length of the class. And so we would have to track it and monitor it. And this was back in the day. So I'd have to get the Washington Post, pull the business section to see how my stock did that day at the open and the close.
The picture of you with a newspaper from the Washington Post, along with your Payless shoes. It's straight comedy.
You just distracted me. I don't even know. So anyway, so my stock was Exxon before it like merged with mobile and everything else. But so he taught us like how to calculate the PE ratio, how to actually track earnings and what to listen to for the earnings call and like all kind of different stuff that at 12 or 13, like what are you going to use that for? Except I was going home like every week, like, Mom, you got to buy Exxon stock. Like, I'm telling you, it's going to take off. And she's like, okay, like, thanks, dude. And I'm like, no, I'm telling you, you got to buy Exxon stock. And so at the time I told her that, it was probably trading at like $80, $82, something like that.
Yeah.
By the time the year was over, it was like 120 something. And so I'm like, I told you needed to be buying. But my mom was like, why am I going to listen to a 13-year-old about what stock I need to be buying? Like, my mom had a financial advisor, first of all. So she's like, why am I going to listen to a 13-year-old about stock tips? So that was kind of my like, and I still bring it up. I still be like,
you missed out.
If I tell her something and she's like, I'm not sure, I'm like, remember Exxon?
That's funny. That's funny. I had a roommate too whose entire college bill, the 4 years, was paid for by Exxon stock.
Really?
Yeah.
I mean, it had a nice dividend.
Yeah.
I
So anyway, well, speaking before you became a professional in the financial management industry, how did your understanding of investing in stocks progress over time? Like, obviously, there's different bands of knowledge. Like, talk about what your bands of knowledge, so to speak, were.
Well, I probably just thought I knew more than I did, which helped me get started faster than I would have had I not. Right. So in college, I opened an E-Trade account because E-Trade coming along in the 90s made it basically so that everyone could access the market, whether you knew what you were doing or not. And I don't know if you remember pre-2008, you would meet a lot of people who would tell you they were a day trader as their profession. I haven't met a day trader in the last 5 years. So that just tells you how little people actually were making, and also how little people actually knew to be able to make a significant run at it. But anyway, so I had an E-Trade account as a college student, and I probably bought and sold 5 stocks over the course of like 2 or 3 years.
Oh, wow. Okay.
Like, not anything meaningful. And I can't even remember specifically what any of the companies were other than eBay. I remember buying eBay. But yeah, so that kind of helped, solidify like my understanding of how the stock market worked. It also solidified my understanding of how to lose money in the stock market, because I remember I had 0 gains in that account. And I also like learned how writing off losses on your tax return worked, because I had a good bit of losses those couple of years that I had that E-Trade account working.
I think for me, the most important thing over the course of my time as an investor, whether I was a heavy investor or a light investor, wherever on the spectrum, was just each time you have an experience with it, it informs your next experience. So it informs you that you lost money and that you can actually do something with that loss, or it informs you that you made money and then that maybe you should sell it. Or for me, it's just been a compounding, no pun intended, experience of understanding what one action had on an outcome, and that it builds confidence, I think, is what I'm trying to say over time. So another piece that we pulled for this particular story, learn how to become a better investor. This was a November 2019 piece on thebalance.com by Dana and Spatch. Better investing doesn't happen accidentally. Good investors consistently work at it. They study and they learn. Start with 10 ways to become a better investor, and once you start learning, never stop. A couple of things on that list. Treat your money like soap. This one was actually kind of funny. Gene Fama is a famed academic in the field of finance. I've been told that his son once said, your money is like soap. The more you handle it, the less you have. So true. Moving money entails transaction costs, sometimes tax consequences, and most often you're going to move it at the wrong time, Malcolm. So break that down a little bit. How does moving or interacting with money, particularly in the stock market, a lot of times end up costing you money?
So the phrase the old guys in the industry like to use is that it's not about timing the market so much as it is time in the market. But what that really distills down to is that sometimes catching the absolute worst days in the market devastates you in such a way that it really knocks you off course forever. So there's all these charts out there that portfolio managers and professional investors like to use that illustrate, say, the best 10 days in the market, and if you were out of the market for any one of those 10, what the drag on your portfolio is longer term. And if you were out for all of those 10, God forbid, what that then meant for you longer term. And so like allowing your money to actually go to work for you all of the time is what matters. So I made the connection between 2008 where everything falls down. So if you think the first half of a V, and then everything shoots back up the next 3 months, March 2009, the other half of the V, if you got out halfway down on the left side of that V, you never caught any of the upside, which is what happened to a lot of people. And so you missed out on the return that would have brought you back whole and then some. So it's really about making sure that you allow your investments to run their course. So I always, try and help people understand when you're building this investment portfolio, this is money you're not planning to do anything with for 12 months at a minimum. Like obviously you'd love to have longer than that, but at least 12 months is what you should be willing to give it before you say this isn't working.
Another item mentioned in the story, learn the term dollar cost averaging. Dollar cost averaging is a strategy used to reduce market risk by automatically investing in a set amount of money at regular intervals. It forces you to buy more shares when the market is down and buy less when the market is up. Smart savers automate their savings plans and let them run for years and years at a time. Be a smart saver, and if you don't already, start dollar cost averaging. And Malcolm, that's essentially buying the same batch of things over a course of a period, and explain what that means for people very quickly.
Yeah, so I just gave you the example of, accidentally catching some of the worst days possible or being out of the market on some of the best days possible. Dollar cost averaging allows you to do what you can to make sure that that doesn't happen. So you're buying on some of the worst days and you're buying on some of the best days, and ultimately it kind of averages itself out. So if I say over the course of 12 months, I want to put this $10,000 that I have saved to work, then that means 1/12 of $10,000 was at 83.30 something. I'm actually investing monthly intervals, weekly intervals, however I decide to do it. That allows me to capture the average of what the market is over that year.
Indeed. Another item, if you can't stand the heat, steer clear of the fire. Stocks are not for everyone. You can build a solid financial plan using only guaranteed or safer investments. If you don't understand the stock market or what a mutual fund is, it's probably best to avoid these investments altogether until you learn more. If you do understand but get too nervous, then stay out of the market, which is relatively straightforward.
Don't invest in things you don't understand.
Correct. Golden rule there. Also, know what you own. A stock is not the same as a stock index fund. A bond is not the same as a stock fund. It is amazing how many people who own large cap equity mutual funds react to an irrational fear that they can lose all of their money. Do they have any idea what they own? Do they really think all of the 500 largest companies in the U.S. are going out of business at the very same time? Also, another item, read books, not just websites. I love the internet. The amount of information available is astonishing and at times overwhelming. However, get to the depth of knowledge on the topic. I think still nothing beats a good book. Educated investors earn higher returns. Commit to learning first, and you'll become better at investing. And I know this is true for me, especially when just breaking down the barrier of information and feeling comfortable with doing something. I know that I read tons of books on investing and personal finance just generally, and all those things edge me towards feeling a little bit more comfortable.
When you say the internet, though, does that include Instagram?
I think on this show, we do not include Instagram on anything.
And not Twitter?
No, not Twitter
TikTok.
Either. No,
I don't. Snapchat?
No.
Okay.
None of the information that we're talking about.
Because there's so many investment gurus on social media.
Excuse me, ladies and gentlemen. Allow me to push the soapbox.
No, I don't even need the soapbox. I just want to make sure that for this episode, while we're talking about this, we make the distinction that the internet and social media are not necessarily one and the same. If you want to conflate them together, then.
So we're creating a line between social media and the internet generally.
Yes. I mean, not to say that everybody who posts or publishes something on the internet itself knows what they're talking about either.
Correct.
But there's a higher probability that you've taken the time to research the thing that you're writing about if you're willing to commit 2,000 words to it versus 280 or a 6-second video. That's all I'm saying.
Indeed. No need for the soapbox here today, ladies and gentlemen. And then finally, remember, they don't know you. Who is they? All of the people, including me, who offer advice and financial commentary to the public. We don't know you or your situation, but you do, so make critical and well thought out decisions. And
okay, so again, they include Susie Orman. I'm just asking a question. Does it include Dave Ramsey? because they give out some very general advice to all, and I just want to make sure they is
well defined.
okay.
And I'll actually jump on that a little bit and create a distinction here, because we never actually give specific advice on this show.
Intentionally.
We do that intentionally.
Not only because my compliance officer would like
say
we'd
so.
We'd have a meaningful conversation. That's the way I'll say it. But also because it's not our place to.
Correct.
Like, we're not in the business of giving blanket advice to strangers, because what's good for one isn't necessarily good for all. Mm-hmm. But with that said, there are some very clear-cut guidelines, like don't invest in things you don't actually understand, that I'm very confident pertains to everyone.
Right, correct. And I think for us, it's more about making sure we facilitate a thoughtful conversation about what you can do to help improve your financial situation. The more you know. So a couple quick questions before we close the show, Malcolm.
Sure.
Say someone is watching or listening to this show. They know they have some cash sitting on the sidelines. What should be their first step in understanding how to dip their toe into the stock market space? And how do people know when they're ready to actually hit buy when it's time to?
So I think the first thing is, like I said, actually setting a timeline, right? Like, if you are planning to buy a house and so you have $50,000 sitting in a bank account, but you know you're going to buy that house within the next 12 months. Right. Not the time you want to be building an investment portfolio, because what if, as we mentioned, we're almost 11 years into this bull market. What if we're at the top side of that 11 years, you press that whole 50,000 into the market, and all of a sudden market fears bring it down 20% over the course of like a week, which is absolutely possible. Right. Now your $40,000 down payment to that house doesn't go as far as the 50 would have, and completely changes some things in your world. Right. So you do want to take those things into account, but also I would just say, as you're planning on getting invested in the markets, have a strategy for whether you consider yourself an ETF investor, so you're an exchange traded fund person. You would prefer a larger representation of the market to mitigate the risk, which also means
stocks
that
and grocery bags. That's how I think of them.
Okay. So I think of mutual funds more like the grocery bags, and ETFs like the whole shopping cart. Okay. Because ETFs tend to have a larger swath of the market because they're tracking an index. Okay. And so they're going to have a much broader representation. Whereas in a mutual fund, you might have 100, 50, 25 actual stocks inside of that basket. Okay. So that's the way that I would say it breaks down. But everybody's got a preference. Right. So knowing what kind of investor you are, if you can stomach owning 10 companies and being at the mercy of what 10 CEOs decide to do and the market economics of 10 companies, if that's your bag, then by all means, do your thing. But if you know that you're not willing to take that level of risk, then, stick to shallower waters.
Indeed. And I think this is an important component, because when you and I first started investing, it was pretty expensive to actually trade online. So
$11.99 was
yeah,
trade.
I was thinking $12.99 for whatever reason. I was on Share Builder initially. And it got bought and sold a bunch of times.
Sounds vaguely familiar.
It's a really old one. And then it got changed to ING Bank, and then it moved to Capital One. Anyway, talk about what happened recently in terms of the cost of trading, especially if you're a self-directed investor, in two ways. There are the no fees, and then there is also the emergence of these relatively low-cost auto investing platforms that you can use. Talk about both of those and how that might help people kind of get their feet wet.
So I'm not convinced that no fee is good for anybody, frankly, because I think I don't know if you recall, I hope you would recall because it wasn't too long ago, but we had an episode where you were educating me on bullet journaling for money. I don't remember what the term is actually called, but it's basically that.
Kaibo.
There you go.
Anyways, go ahead.
So it's that, and so you were talking about the fact that having to write down this expense you just spent money on is enough of a deterrent sometimes to keep you from making frivolous purchases. I think having to pay some level of commission or fee for placing trades sometimes is a good enough deterrent to keep people from doing things that they wouldn't do otherwise because it's so freely available.
It's made me think twice.
That to me, I don't think it should be $11, $12 either, but I do think if it were like $4.99, like I think Schwab was, or even $1.99, something to make me go, do I really want this? Because if I go to buy a ticket for an event on Eventbrite and it says the fee is $1.99, I seriously take a second and go, do I really want to go to this? So I just think that deterrent is necessary for some people. On the flip side, what you were talking about with robo-advisors, I think the jury's still out.
Okay.
The challenge I had, so robo-advisors basically are computer algorithms that aggregate your money with a whole bunch of other people who also use that company's service and pool your investments into ETFs, mutual funds. I don't know that so many of them go to individual stocks yet, but for the most part, they're just trading a basket or a portfolio of funds, mutual funds or ETFs on your behalf. To your point you were making, though, the performance in that hasn't been anything that's so super great that, excuse me, it makes me think that it's better than you just buying a couple of mutual funds or ETFs on your own and calling it a day. But I do think what we're headed for, which kind of lends itself to the reason we're having this conversation in the first place about people's overconfidence, is that once the market does start to experience some significant shocks to the system, which we have to be closer to than we were 10 years ago, say, all of these people who are do-it-yourselfers would start to wash away because people will start to realize, like I talk to people and they're like, why would I pay anybody to manage my money? I've been doing 20% on my own. Well, the S&P did 30-something last year without you having to make any real decisions if you just bought the S&P index. But in a year where it does 2, now you're not as confident. Or in a year where it does -2, now you're not as confident. And I think that is also what has created some of this that has made everybody feel like I can just jump in and do what I want, and I'm definitely going to make money.
Right. Excellent, excellent. Well, generally speaking, if we were to leave the show with one piece of straightforward, time-tested advice or thought on solid returns, or even just, doing decently in the stock market or getting started, what would that be?
If you're just getting started, mutual funds and ETFs are your friend. And as you mentioned, dollar cost averaging is a great way to go about it because it allows you to set it and forget it.
Okay. And that's where we're going to close this show. I want to remind you can catch Manage Your Damn Money as a podcast on Apple Podcasts, SoundCloud, Stitcher, Google Play, and Spotify. Please leave us a review on any of those platforms. That helps more people catch the show. If you have any questions for us, you can send us your thoughts, info@manageyourdamnmoney.com. And of course, you can always catch us on social media, that thing where you can't find any valuable information at all whatsoever. My handle's @MYDM1. Malcolm, what's yours?
@Malcolm on Money.
And that's Instagram and Twitter. And of course, Facebook, facebook.com/Manage Your Damn Money. Thanks once again to our partners here at Montgomery Community Media for their amazing hospitality. And once again, we always remember, be good with your money.
Peace.
Peace.